Good morning and welcome to today's webcast, Navigating Retirement Risk for Plan Sponsors and Participants. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And Bertha, I'll turn it over to you to get us started.
Thank you. Good morning, everyone. So excited to be here. Thank you for joining us. We have a great presentation for you today. I'm Bertha Minnihan. I'm an audit partner with Moss Adams. I have the privilege of leading our employee benefit plan practice, and we audit over 1,600 plans, across defined contribution, defined benefit, health, and welfare. So we see quite a bit, and I'll be sort of moderating our wonderful 2 speakers, and I know you want to hear from them, so I'm going to introduce them and jump into some polling, and then I'll interject and monitor our questions as we go. So Kelly Coffing is a principal and consulting actuary with Milliman, and Kelly works on out of their Seattle employee benefit plan practice for Milliman. She joined the firm in 1997. She serves as a consulting actuary for a variety of multi-employer pension plans, and she assists clients with a lot of aspects of pension plan management, including actuarial evaluations, plan designs, negotiations on pension plan changes, experience studies, plan administration, and participant communication. So wealth of knowledge. And Arthur Rains-McNally is joining her as well as consulting actuary with Milliman. And Arthur joined Milliman in 2000, and his area of expertise is the broader employee benefit plan field. He serves corporate, multi-employer, and public sector clients. And he has experience as well with a lot of aspects of defined benefit plans, retiree medical plans, actuarial evaluations, experience studies, pension administration, and individual benefit calculation. So as you can see, we have a lot of depth here today. We kind of named our webinar, our presentation, Navigating Retirement Risks for Plan Sponsors and Participants. As we all, as you have, folks on the phone may have even gone through some navigating some of the risks with pension plans, or you're reading about them in the news. Americans are living longer and longer, and we're saving less and less. So sponsored retirement plans are becoming really the main nest egg for folks as they retire. So as sponsors, public, private sector, in any line of work are kind of working through their fiduciary duties, they're really looking for ways to maximize retirement benefits for their employees. And that is navigating through a lot of plan design risks and a lot of plan administration, again, to maximize that amount. So that's what our two speakers are going to talk about, a lot of things revolving that today. The speakers have preferred to take questions as we go, so we'll be monitoring the relevant questions or, covering them at the end, which will leave some time for then. If we don't get to cover all the questions, we will be putting out responses to all the attendees. So, we're hoping that you'll find everything informative and a chance to get answers to your questions. So we're going to jump into a polling question because we like to kind of see our audience. So Emily's going to help open that for us.
Our first polling question is, in which sector does your organization work? And your options are A, corporate, B, government, C, union, Taft-Hartley, or D, other. And I'll give you a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit.
And I guess other, could be if you're a charitable organization, for example, it would probably be other, and it usually helps us to kind of better know our audiences because, as you can imagine, it's kind of tough to talk about a lot of general things, and some things are specific to certain organizations.
All right, and let's take a look at the results.
Okay, so as expected, we have 24% others, so we do have lots of folks that could be kind of a unique organization, and most are corporate, so in our private for-profit, which is actually typical as well. So great, well, welcome everyone, and I've advanced, and here's just some bullet points on what we are going to cover on some retirement basics. The speakers will define the various risks, compare the risks, talk about a lot of alternative plan designs and fun things they've seen. And in the case studies is where it's cool, and we're going to kind of go through some scenarios. So I'm going to turn it over to Kelly.
Hi, everybody. The first thing we want to do, as Bertha mentioned, is talk about some retirement basics. In looking at the group that's on the call, my guess is most of you are quite familiar with many of these first retirement basics, but we want to make sure we lay a groundwork so that when we move on to talking about risks, we're all on the same page. So there are really three main types of retirement plans that we use in this country to deliver retirement benefits. And those are defined benefit plans, defined contribution plans, and alternative plan designs. A defined benefit plan, which we're probably going to call DB plans, those are really where we define the benefit at retirement, either as a portion of pay near retirement or some accumulated benefit where a certain benefit is accumulated each year and the sum of those accumulations defines a benefit at retirement. Once someone retires, that benefit is designed to be paid for life. And so we've defined the benefit at retirement. It's the sponsor's job to make sure that there are assets sufficient to fund that benefit. In a defined contribution arrangement, it's essentially the opposite of that. We define the contribution that's going to go in, so the sponsor and perhaps the participants have a certain contribution that they put in, and then that money is invested, typically at the participant's discretion, and then the benefit in retirement is the accumulation of the assets that the participant was able to accrue. And so the benefit isn't defined, but the contribution is. And then there are alternatives generally designed to sort of split the difference between these two things, where we maybe are interested in giving participants some participation in market returns, where we're interested in having the sponsor have a little bit less of a volatile contribution requirement. And so the alternatives are designed to somehow split the difference between the risk portfolio and the behavior of the plans. So common alternative plans are cash balance plans. There's a very old plan design called a variable benefit or a variable annuity benefit, which is regaining some popularity. And then we're going to talk a little bit about a variation on the variable benefit plan, which is a sustainable income plan, which we've had quite a number of sponsors implement in the last couple of years. With that, we're going to turn it over to another polling question.
All right, our second polling question. What types of retirement plan does your organization offer? And you may select all that apply. A, defined benefit, B, defined contribution, C, cash balance, or D, other. And if you're having any issues seeing the poll today, if you could try refreshing your browser with F5, hopefully that will adjust the screen for you. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone a few more seconds here. And let's take a look at the results. Kelly,
this is no huge surprise. I think we see most sponsors now are sponsoring defined contribution plans. There's some reasons for that we're going to talk about in a little bit, but there's still some folks that are providing defined benefit plans. Probably some of those are open, some are closed, and then there's a smattering of other plans. And I would say that's pretty typical on calls like this, but also in terms of what we're seeing across the country. I want to start this conversation or continue this conversation about retirement plans by throwing out this equation. For those of you who are familiar with ERISA, which is the federal law which governs private pension plans in this country, I don't know if it's 6 or 8 or 10 inches thick, but it's a massive, massive amount of law. And those laws are designed to protect us all sorts of interests. But at their core, pension plans are really very simple. There are only 2 sources of income. The contributions that come in either through the sponsor's contributions or through participant contributions, and the earnings in the marketplace on those contributions over time. And together, those contributions plus investment earnings have to fund the benefits that are paid. And over the life of the plan, this equation will be true, that the contributions plus the investment earnings have to equal the benefits plus the expenses to administer the plan. So we're going to talk, when we talk today about risks and how we allocate risks, we're going to refer back to this equation because it's easy to get hung up in the accounting standards or the law, but at its core, you can't either make money or lose money in a pension plan. You can't have negative investment earnings, but we're really stuck with those 2 sources to pay benefits from. This is sort of a pictorial representation of that, where you have contributions coming in, investment earnings. For those of you who are very mechanically savvy, you'll notice that this valve can go either direction. The yellow valve, the yellow pipe has some valving, so that investment earnings can either add or subtract from the pool of assets, and then from that pool of assets we pay benefits and expenses. In times like this, when plans aren't necessarily living up to our expectations, I think it's a good reminder to think about why we have these plans in the first place. And I think if you look in the lower right of this slide, you'll remind yourself why you sponsor a plan in the first place. In large part, you need to have a retirement plan as a recruitment and retention tool. You've got to attract and retain top talent. And then ultimately, once someone's career is complete, you want them to have an orderly exit from the workforce. It's very expensive to have employees work significantly longer than you are expecting them to. Older workers tend to cost more in terms of health benefits and productivity, perhaps, particularly if they're staying long past when you anticipated they would retire. So we have plans for this workforce management issue, attraction and retention. But that advantage comes at a cost, which is right above that in terms of the finance situation. Ideally, we want our retirement plans to stay fully funded, to be able to weather all market conditions without having wild contribution requirements. We want stable and predictable contributions, and we want stable balance sheets. And ideally, we want to maximize the value of the contributions that are put into the plan. That is, you want to maximize the amount of benefits you get out for the contribution that you're putting in. And ultimately, those two business needs result in participants having benefits in a retirement plan. So ideally, for participants, we provide lifelong income. For most participants, they don't really want to make complex investment decisions. Ideally, plans would provide some inflation protection. And again, the participant should have some interest in having an efficient benefit where they get a maximum of dollars per dollar of contribution. And I'll turn it back to Emily for the next poll question.
All right. Our third polling question is, what are the biggest stressors on your organization's retirement plan? And you may make multiple selections. Value of benefit, size of contributions, cash contribution volatility, income statement volatility, balance sheet volatility, or other. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We'll be sending the slides via email after the webcast. And it looks like we have the results.
Okay. I think that what we see here is, again, that there's sort of some concerns all across the board. This is fairly common to have the size of contributions be difficult and income statement volatility. Both of those are a problem for sponsors. Sometimes we see a greater problem with item C in terms of cash contribution volatility, but these are the kinds of problems that we typically see. Mostly, income statement volatility is a problem for sponsors of defined benefit plans rather than defined contribution plans, but the size of contributions can be an issue for all sponsors. With that, I'm going to turn this over to Arthur to talk about risk.
Hello, can everyone hear me?
Yes.
Okay, so when we were asked to do a talk about risks in retirement, my first question is, do I get a whole semester to talk about this, or an 8-hour course? But no, I get 10 minutes for this section. There are nearly infinite risks in retirement, but we're going to focus on a few. We made a very long list here that apply to employers, employees, and general risks. The ones that we're going to cover here in some detail are highlighted in blue, and that's going to be investment risk, which is the risk of the market, interest rate risk, which is the risk of interest rate changes, longevity risk, the risk of living too long, which is good for some people. We would like to live longer, and inflation risk. Now, there are a whole slew of other risks that we could cover in another session, from some employer risks, which regarding workforce management or regulatory risk, or employee risks, where we're talking about some risk like spending risk, earning risk, or even cognition risk. I mean, do you really want to be managing your money when you're 95? Those kind of risks we can talk about in a different session, but today we're going to focus on these blue topics. So the first of those is investment risk. So let's back up. Why do we invest? Kelly showed a chart at the very beginning, the formula for pension plans, which really is the same formula for a 401k plan or an IRA or even your savings account, really, is you only can get contributions plus investment earnings. Those are your only two inputs. So you want investment earnings, but to get investment earnings, or at least to get good investment earnings, you need to invest in risky assets. So what this chart shows is its annual returns for a portfolio of effectively 60% stocks, 40% bonds. And the orange line there is the expected returns of about 7.5%. And what you'll see is over this roughly 100-year period that the markets actually only listen to us about twice, meaning that there's a lot of volatility each year, and some are much higher and some are much lower. And we like it when it's much higher, and we have a lot of pain when it's much lower. So why is volatility a problem? Well, as you get closer to retirement, your investment period shrinks. So if you're an individual investor and there's a big market drop, you just don't retire. And we see that a lot, and I imagine that you see that in your organization with after 2008, many people delayed retirement for multiple years. And that can be a strategic problem to any organization. It's also a challenge for defined benefit pension plans where the promise is guaranteed, a guaranteed monthly payment. And if the assets are volatile but the payments are steady, there's constant pressure that the return needs to be there. And so the downside is really hard to deal with, and the upside is always nice, but the volatility is the challenge. Our second risk is longevity risk. And, it's always good news to tell people that they're living longer until we have to plan on how they're going to pay for living longer. Longevity risk in this case here is really the risk of not knowing how long you're going to live. And when you have a 401k plan or an IRA, you have to plan how you're going to take that money down. So say you're age 65 and you retire with $1 million. How much can you draw on that each year to make sure that you have enough money for your entire lifetime? This graph here shows the probability of living to each age based on a very common mortality table. This is if anyone who has a defined benefit plan that has to do financial accounting, they in general will be using an RP 2006 table with a mortality improvement projection of MP 2017, and this is for males. Okay, that's a bunch of gobbledygook. What's important to know is that if you're age 65 male, there is about a 50% probability that you're going to live to 85, which is 20 years in retirement. So is your planning horizon 20 years and and you're going to accept a 50% probability of running out of money? Most people would say no. So maybe they're going to plan to live to be 91, in which case there's only a 25% chance of running out of money. Well, I'd hate to be 91 and having to go back into the workforce to make up the difference when I run out of money. So the planning, this longevity risk, is really a challenge for an individual to be able to plan for. However, we have a little thing called the law of large numbers, which allows us to plan for this very well on a large group. So if you take 1,000 people, you can very accurately predict how many people will live to be 85. I can't tell you which individual person will live to be 85, but I can tell in aggregate how many people are going to live to be 85. So one of the solutions to longevity risk, just to steal some thunder from Kelly, is whenever you pool people, you can solve a good portion of the longevity risk. What you can't really solve is the fact that people are living longer, at least not as easily. So this second chart shows the dotted line is the dotted line is the last chart superimposed. And what you can see is that the probabilities have increased. This chart now shows what longevity is expected to be 10 years into the future. And on average, the age 65 male now is going to live to be 86 years old instead of 85. So 50% probability of making it to 86. And the 90 goes out to 91 goes out to 92. So in general, every 10 years, people are going to live about 1 year longer. Now that's a risk to pension plans because they're paying out monthly benefits for life. So they're going to pay an additional year worth of benefits. The nice thing, though, is it happens very slowly over time, and it's smooth, so we can plan around it. Unlike the individual who can't really plan that if they're going to live to be 100 or 85 or 90. I mean, that changes their income in retirement significantly. The third risk that we're going to talk about here is what's called interest rate risk. Now, this is the interest rate risk. The challenge with interest rate risk is that this is primarily going to be for a defined benefit plan. But what this is financial accounting standards require that you measure your liabilities using a market rate that could be settled today. So what I've shown in this graph here is one pension plan who has promises into the future of monthly payments, for the life of the plan, just measured at different discount rates based on the rates that were available in 2009 through 2017. Over that period of time, interest rates changed from about 5.89% to 3.55%. The real takeaway here is that the liabilities, that measurement of that promise, varies from about $1.2 billion to about $1.8 billion, or 50% variability, simply because bond interest rates changed. It doesn't change the promise, but it changes the measure of the promise, and that creates an incredible amount of volatility for balance sheets and also an incredible amount of volatility on income statements. Next up is inflation risk. Now, inflation risk we're all familiar with, but now that we recognize that the average male is going to live 20 or more years in retirement, average 65-year-old male will live 20 years in retirement, inflation becomes a significant issue. If we assume 3% inflation, which is pretty standard long-term inflation assumption, the purchasing power of $1,000 drops to about $642 15 years into retirement, and all the way down to $400 30 years into retirement. So that eats away at your purchasing power, and both for a defined benefit plan, but also for a 401k plan, you need to draw more money to have the same buying power. So with that, I'm going to pass it on to Kelly to talk about how these risks compare for various different plans.
Arthur, I was just going to jump in with a question that's come up related to risk regarding the investments, and maybe we can all chime in, and Kelly, you can chime in. Are we seeing sponsors investing in like PE funds, or is that prohibited? What are you seeing on the investment side for sponsors selecting for DB plans?
So private equity is something that is used by many plan sponsors, especially the larger plan sponsors that have, larger balance sheets, so they can do that. There is a fiduciary responsibility to invest prudently, but that is a pretty wide latitude. So private equity is used for many pension plans, and I think that there may be a slide. One of the things that pension plans have done over time as expected returns on assets have dropped, is they have become more aggressive in many ways, searching for that return through private equity or real estate or other more exotic means. Kelly, do you have anything on that?
No, I think that comment covers that.
Yeah, what we've seen, of course, as auditors, is the investment policies, right? I mean, we'll always say, even though DB plans are sponsored by employer and not participant directed, but to both of your points, I mean, we're seeing, them obviously be aggressive sometimes, and depending on their demographics. But we do tend to recommend investment policies to make sure that fiduciarily they have a roadmap of what they want to invest in, and sometimes monitor, because I think even though you still have a fiduciary duty to maintain a certain level of investments and prudency and things like that. So that's what we usually see. Great.
Okay. So we've talked now about the common plan designs and then the retirement risks that are inherent in retirement. Now what we're going to do is walk through how those risks are allocated, those four major risks that Arthur talked about, how those are allocated in different plan designs. And we think this is important to understand how your allocation or how your risks are allocated so that you can begin to make rational decisions about how to proceed. In a traditional defined benefit plan, the old style pension plans, the risks are allocated in this way. So between plan sponsor and participant, the plan sponsor is bearing the largest portion of the risk. So as Arthur mentioned, you can have a 50% swing in the liability of the plan over 10 years for no reason other than changing of yield curves. So that great big red risk is that interest rate risk, and you can see it's quite large. And likewise, the investment risk is large. We are investing, if you went back 30 years or 25 years, you could invest almost exclusively in bonds and get a 7 or 7.5% return. And now the portfolio required to get a 7 or 7.5% return includes a whole bunch of exotic allocations. And so what's happened is, to get the same return, you have to take on more investment risk, and that risk is very large. Whenever those two risks zig and zag opposite each other, you can end up with really large contribution requirements or a lot of balance sheet volatility. The plan sponsor is also bearing the longevity risk, but you'll see it's very small. And the reason is, as Arthur mentioned, that we've pooled the longevity. There's not no cost to that. As people live longer, incrementally, the cost of the plan will go up a little bit, but it's quite predictable and it's quite small. On the other side of the equation, at least in the private sector and in the Taft-Hartley or multi-employer sector, the participants generally bear the inflation risk. That is, they retire with a benefit of, say, $1,000, and then it's their job to, and then that $1,000 is still going to be $1,000 in 30 years, and so they're going to have to come up with some other source to manage that inflation risk over time. In the public sector, government plans very often include in the defined benefit itself some inflation protection, at least partial inflation protection. And so that risk in the public sector is also partly borne by the sponsor or wholly borne by the plan sponsor. So defined benefit plans really put the biggest burden on the sponsor in terms of the retirement risks. This becomes a big problem for plans when the plans become really large compared to the size of the companies. So what sponsors have done in response to bearing all of that risk is they have essentially gotten out of the defined benefit plan business. If we were to go back and look at the private sector workers in America whose employers offered a retirement plan, in 1979, 84% of those participants would be covered by a defined benefit plan. However, by 2011, only 31% of those workers are covered by a defined benefit plan. So we've really seen a swing. If you look at that from the dotted line, go clockwise all the way around to the bottom of that 31% wedge, that whole half is the increase in defined contribution plans that we've seen over the last 30 or 40 years. And that change has been due to sponsors not wanting to bear such a large portion of the retirement risk. That retirement risk hasn't gone away for those employers who continue to sponsor pension plans. If we look on an accounting basis at the 100 largest corporate pension plans in the country, they made record contributions to their plans in 2017 and improved their funded status to 86%. So they aren't fully funded and they're making large contributions. And in large part, that's due to having a decade of flat returns through the 2000s in conjunction with having interest rates that are very, very low and therefore their liabilities are quite high. This shows the position of those 100 biggest pension plans over the last 20 years or so, and you can see that they were in a surplus position in 1999, 2000. The dot-com bubble caused them to be underfunded. They just got overfunded again, and then since the housing and financial crisis, we've really seen those plans struggling to get back to fully funded. So this was the risk profile employers were trying to get rid of. This is that defined benefit plan risk profile again. And what they switched to when they moved mostly to defined contribution plans is this. And we've essentially then wholesale moved the retirement risks off of the sponsor and onto the participants. And you'll notice that the risk, the longevity risk, went from being very small to being very large. And the reason for that is that as an individual, you don't know how long you're going to live. And so because you could live to be 75 or you could live to be 95 or you could live to be 105, it's very, very difficult to manage your assets to last for your entire lifetime. And if they do last your entire lifetime, you have enjoyed probably a lower standard of living than you could have. Investment risk is very large, and people need to stay invested in the markets to make sure they can have some assets. They have to manage their own inflation risk. And if they want to do something to mitigate their investment and longevity risk, they expose themselves to interest rate risk if they try to purchase annuities or something of that sort. Behavioral economists would say that these plans, that defined contribution plans, are very, very difficult for individuals. We tend to buy boats and cars instead of saving for retirement. We are generally pretty terrible at setting aside money now for use in the future. There have been some things that have been done recently to improve this. We've put in auto-escalation features and auto-enrollment features so that people, when they have to actually opt out to get out of the pension plan or get out of the 401k plan, and then if they don't get out, their contribution rates continue to escalate up to some set point over time. This does not change this risk profile, but it does give them more assets to work with. we're starting to see now a whole generation of Americans who have primarily had their retirement benefits delivered to them through 401k plans. And the people who started 401k plans in the first place are sorry. As it turns out, these aren't very good primary retirement tools. People really just aren't doing as good a job as we had hoped they would do, and 40 years of education hasn't really seemed to turn the tide on that. So 401k plans, while they're great for the sponsor, can be quite difficult for participants to manage. I'm going to read you this quote. Most people are going to arrive at retirement and not have adequate money. This is serious. None of us are good at doing our own retirement savings. Now, my neighbor might have said this, but actually, Alicia Manel said this, who is at Boston College and studies retirement plans for a living. So I think it's a very serious condemnation of 401k plans and something that we should probably look at as we move forward. What some companies are doing is trying to fix this by adding some more money as a way to have themselves stand out. They're realizing that their older workers are delaying retirement, which is costly to them, and so they're increasing their contributions to their 401k plan as a way to try to manage their workforce. The result, however, is that may be too little too late, because we're seeing that a growing group of older Americans is declaring bankruptcy. These are bankruptcies by age group. You can see that there are fewer bankruptcies for people under 50 than there have been in the past. And I could make a joke about millennials living at home here, but there's many more seniors who are declaring bankruptcy. They simply don't have the retirement assets to fund a secure retirement. My favorite behavioral economist is Richard Thaler. He just won the Nobel Prize for economics. And he says the assumption that everybody will figure out how much they have to save and then will just implement that plan is obviously preposterous. I'm all for empowerment in education, but the empirical evidence is that it doesn't work. So these are some hurdles we have to face if you're sponsoring a 401k plan so that you can actually get people to retirement with assets. There's one more piece of 401k plans that I think is worthy of note, and that is that 401k plans, just as defined benefit and alternative plans do, they essentially grow your contributions. So on the left, you can see the contributions the employer makes to the plan, and indeed they are growing. But a 401k plan does not produce as much retirement income as a defined benefit or an alternative plan for the same level of contributions. And in fact, for the same dollars of contributions, you can provide something like 30% higher benefits. According to the National Institute of Retirement Security, that number may be as much as 48%. And the reason for that is people in a 401k plan make poorer investment decisions than professionals. They pay higher fees in retirement, especially if they roll their money over, and then they pay retail fees instead of institutional fees. There's no longevity pooling. There's a lack of professional management. Those things, when they're all added up, result in inefficiency in the 401k market. So I think that that's something 401k sponsors should be aware of. So we've sort of highlighted the difficulties of both of our predominant plans here. Defined benefit plans are difficult for employers to manage. The plans we put in to replace them turn out to be difficult for the participants to manage. And I think we can do a better job of delivering retirement benefits, or at least managing those risks. With that, I'm going to turn it over to Emily, I think, for our last polling question.
Yep, our last polling question: has your organization implemented or considered risk management strategies? And your options are yes, purchase annuities or lump sum window, yes, plan freeze, yes, asset liability matching, alternative plan design, other, or no, and I don't know. And I'll give everyone some time to make a selection. Once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. And I'll give everyone a few more moments here. And let's take a look at the results.
Arthur, I don't know if this is what you were expecting. I know that we've had a fair number of plans look at some of these items, but you can see about half of plans haven't implemented risk management strategies. Is that what you see?
Yeah, well, I think that what we're seeing here is that we do have a lot of defined contribution plan sponsors, and so we have approximately, if I recall the earlier slide, about between defined benefit cash balance and other, we had about 40%. So if you look at all these yeses and you add them up, that's about half of the defined benefit plans.
Yeah.
So it is pretty common.
Yep, that does sort of match my understanding. That's a good point.
Mm-hmm. Yeah, I agree. And the question came up is with everything that Kelly's covered and Arthur to date, do you think that the DB trends are coming back? Are you seeing more defined benefit plans popping up? Because we're most certainly seeing more cash balance plans forming.
Yeah, we are seeing more interest in defined benefit plans than we were seeing. In one of our case studies, we're going to talk about the sustainable income plan, and we have a 401k sponsor who is looking to add an alternative plan design right now. So we've seen a lot of plans transition to alternatives, like you say, to cash balance or to variable plans. But I think we're starting to see 401k sponsors reevaluate and look for some alternatives, not necessarily traditional plans, but alternative design.
Yeah, great. Let's jump into the case studies.
All right, we're going to talk about 4 case studies, actually 3 case studies. I'm going to skip case study number 3 for the sake of time. The first 2 case studies are going to be primarily about defined benefit plan, but stick around for the 4th case study because we'll look at this alternate plan design, which will solve some of the DC plan issues. So I'm going to remind everyone that, again, there's going to be a lot of numbers, and I apologize, coming up. Defined benefit plans, because of the law and accounting standards, can get a little bit complicated when you get into the numbers. But at the core, everything is really about trade-offs because you only have 2 sources of income and 2 sources of outflow. Contributions plus investment earnings equals benefits plus expenses. Kind of the takeaway of basically every talk that I have is that contributions plus investment earnings equals benefits plus expenses. And then these are really about trade-offs, and the certainty is expensive. So if you're going to guarantee a benefit in the future, that gets a little bit expensive. Or if you're going to remove a risk, that's a bit of expensive. So you can manage, reallocate, or minimize these risks, but oftentimes this comes at a cost. So we're going to use one very big corporation of America for all of our examples here, and we are going to take this plan and we're going to go through what actually happened to some clients, some decisions that were made, but we're going to base it all on this very large, very big corporation of America, which is a publicly traded corporation that has assets of about $1.3 billion. It's active, so people are earning benefits, and it's a single employer corporate pension plan. They're currently making about $40 million in annual contributions. Now, I have a whole bunch of different lines here, and I apologize for that, but that's the complications that we live in. First of all, the liability, which is the measurement of the promise, is different for different purposes. And the 3 purposes that we're going to cover here are IRS, which is the minimum funding, those are the minimum required funding. Accounting, that's the accounting that is required for financial disclosures, and then also the Pension Benefit Guarantee Corporation, affectionately or not affectionately known as the PBGC. They have a requirement. They're kind of the insurance company for pension plans. So for this particular plan, we are in a pretty good funded position for IRS minimum funding. We're about 111% funded. But on an accounting basis, which is measured based on what we could settle it at today, we're only 70% funded. And then the PBGC is kind of in between, and it's about 90% funded. The value of benefits that are being earned each year for this plan is about $40 million, but the accounting rules require that to be measured higher, and that's about $70 million. The other things to know is that there is no minimum required contribution to begin with, and the accounting expense, which is kind of like the paper money, that's what's going to go on the income statement, is about $74 million. Okay, so this is the background for the plan, and I, again, apologize for so many numbers, but the first case study we're going to talk about is the plan decided that, or the company decided the plan was too big relative to the size of the company. So they wanted to do what's called right sizing, which you can do in a variety of different ways. But the problem was the plan was too large, and there's a lot of balance sheet volatility, and there was some concern about that a future market downturn would require very large contributions. So what the plan sponsor did is they went to an insurance company and they purchased annuities for their retirees, thus transferring their obligation from the plan to the insurance company. And they paid for that. The cost of the annuities ended up being about 105% of the PBO. What does that mean? That means that they ended up paying $500 million to the insurance company, and what did they get in return? They passed along $475 million of liabilities. Okay, so what does that look like after we do this? So you paid $500 million, and so your assets go down by $500 million, and your funded percentage across the board goes down. But there's an advantage to this, and the advantage fundamentally is that, just move along real quick. I'm going to skip a couple slides for time. The advantage really is now that the plan size is more in line with the corporation size. And what does that mean? That means that if assets dropped by 10%, previously, before this, if assets dropped by 10%, they would become $130 million more underfunded. Now, if assets drop by 10%, they'll become $80 million underfunded. So that security was purchased with that $500 million at a premium of 105%. The other thing that the other security that they get then is if they reduce the impact of interest rate changes, because the liability is now smaller relative to the plan. If interest rates change and liabilities go up by 10%, previously it would have been going up by $180 million. Now it's only going up by $130 million. So what they purchased was some security. They purchased less volatility to assets, less volatility to interest rates. One thing I'll note is that this is the exact same impact if this was a lump sum offering to participants instead of an annuity purchase. The difference is if you offer a lump sum to participants, then the participants much manage their assets. Now, one thing I want to just jump back for is what we'll see here, the other impacts, is now the plan is underfunded and it has a required contribution of $55 million, which is about $15 million more. So going forward, they're going to have to pay a little bit more over time to pay for this plan, and the expense went up. One thing to note, and we're going to get to that when we talk about the auditing and accounting impact, because we're here talking with auditors and accountants, is that there is a one-time special accounting expense of $172 million, which means because we settled a good portion of the plan, any of that outstanding loss on the balance sheet needs to be recognized through the income statement. So there's a one-time additional expense of $172 million. Additionally, if the settlement happens sometime throughout the year, the expense becomes bifurcated to the period before and period after. That gets a little bit complicated, and that requires a lot of review with the auditing team, and there's a lot of back and forth in that accounting. But the purpose of buying these annuities is then to make the plan more in line with size. In the actual case, this also came with a large contribution that offset some of the underfunding. Our second case study is one that some of you may be familiar with, is a plan freeze. So in this situation, the company decided that the plan was unsustainable. The expenses was too volatile, the contributions were too volatile, there's too much expense and too much contributions. So what the plan sponsor decided to do in this case was freeze the plan. So they froze defined benefit accruals. Now, if you freeze a defined benefit plan without providing a backup plan, there'll be rioting in the streets. So what the plan sponsor decided to do is replace it with a 401k plan. They replaced it with a 3% of pay 401k plan, which makes their contributions drop from about $40 to $50 million to $25 million a year. Now, that is a significant cost savings, but what they effectively did was cut the benefits dramatically. The impact on all of our numbers here is very small immediately, except for the FASB expense. So we just got rid of all of these all of the future benefits being earned that are being now replaced with 401k benefits being earned. You'll also see that the PBO dropped from about $1.8 billion to $1.5 billion, which is just the fact that now no benefits are no longer going to be earned, and in the accounting standards, you project future salary increases into your plan. So those go to zero. In this case, there is no special accounting required, so the auditing impact is relatively small. There is a lot of benefit audits on the benefit and participant statements, as now that the plan is no longer ongoing. So what was the long-term impact here? Well, the long-term impact is that there is significant cash savings, basically cut in half. But the frozen plan is still underfunded, and so there'll need to be additional contributions to make that up. There is now going to be more balance sheet and contribution stability over time as this grows, and the FASB expense savings is pretty significant. There are some downsides. One is now there's 2 plans to administer instead of 1, and the benefits have been significantly reduced, which means that the future retirees have less income security, ACTAs can delay retirement, and this may, as Kelly mentioned earlier, result in pressure to increase contribution rates, which eats at the savings. So if 10 years down the road, if now a 6% of pay plan, you've now mostly lost all of your cash savings. I will mention very briefly asset liability matching, because this applies also to governmental plans, is that you could do asset liability matching, which is effectively trading security for investment returns in the long run. You lower what you expect out of the market, which means you have to contribute more, but then there's less volatility. And with that, I will pass it over to Kelly for the final case study.
Okay. The last case study we're going to look at is an alternative plan design. Before we jump in, there were 2 questions I want to address. One person asked, this equation Arthur and I keep talking about, where the contributions plus the investments have to equal the benefits plus expenses. Another way to say that might be more effective is the contributions plus the investment earnings less the expenses to administer the plan equals the benefits over time. If that doesn't exactly answer the person's question who had that, please feel free to ask that question again. But that could be a better way to do that, is to say the benefits you can offer are equal to contributions plus investment earnings less the expenses. The other question that was asked is what is driving the transition to alternative plans? And the answer to that is that, and the question sort of goes on and says that the author finds it hard to believe that corporations are being driven by doing the right thing. And I think that that's true. I think there's a business need that people are encountering to get them to transition to alternative plan design. So one of the problems we're seeing with defined benefit plans, traditional defined benefit plans, there's just the contribution and balance sheet volatility tends to be a problem, so that drives people who still sponsor defined benefit plans to alternatives. But for those folks that are in defined contribution arrangements, what they're seeing is that they can't control retirement behavior very well, so people will delay retirement until they feel like they have enough assets. So when people feel like they have enough assets is really driven by the markets. So you'll have a whole bunch of people retiring at once, leaving, when we have a big run-up in the market, a whole bunch of people retire. So that leaves behind a bit of a vacuum sometimes in terms of institutional knowledge. In addition, as those folks are delaying retirement, because older folks may have reduced efficiency at work, have higher medical costs, the costs of having somebody work an additional year are very high. Another thing that's happening with those delayed retirements is that mid-career workers are saying, gosh, I don't see when my promotion's coming. I thought I was going to become top-level management, or I thought I was going to get to do something else. And so they are bailing as they see people continuing to work many more years past when they thought they would get a promotion. And so they're seeing an exit of some of their best talent out of the organization. So it's really driven by workforce management issues, and they're looking for alternatives that really give them the same sort of contribution stability of their 401k plan, so that they can retain sort of level costs, but provide benefits that are more meaningful to people and that don't have people feel like they have to retire at a really certain time or delay retirement for a really certain time. So those are the sorts of things we're seeing people talk about. So in this alternative plan case study, we're going to continue with the same company that Arthur was looking at, and the sponsor's problem is that they have contribution and balance sheet volatility. The pension plan is large compared to the size of the company, which makes that volatility larger than it would be otherwise, and they don't have an interest in moving to a defined contribution plan. So this is based on several actual studies that we have done, and what people tend to do when we look at a whole variety of alternative plan designs is people tend to land on the sustainable income plan. They tend to adopt the sustainable income plan on some effective date, say January 1, so benefits will be earned through the traditional plan through 12/31, and then within the same plan, benefits under this new design will start January 1, and then all future benefits will be earned under that new design. If you were to do this from a 401k plan or some other defined contribution plan, you would start a brand new plan. So you'd still have presumably your defined contribution plan, and you would add a second plan for the alternative. In this, we're looking at a typical example where the sponsor wanted to keep a benefit that was about the same size as they were currently offering. And so you could do this by offering a slightly smaller benefit, but in this case they wanted to offer a benefit of similar size, and so their contribution requirement went up about $10 million a year, so from $40 million to $50 million a year. What we're looking at in terms of these benefits, I think it's important for us to back up and actually look at what a sustainable income plan is. I think lots of people are familiar with what a cash balance is. I don't know if folks are familiar with variable plans, but I'm going to introduce both the variable plan idea and then the sustainable income plan idea over the next couple of slides. So the benefits in a sustainable income plan and in a variable plan are earned on a career average basis, so not a final average earnings, but career average earnings. The liabilities are calculated at a plan feature called a hurdle rate. The hurdle rate is generally set between 4 and 5%, and because the liabilities are going to be calculated at that hurdle rate, the plan is no longer interest rate sensitive. And so all of that volatility you see in the liability calculations goes away. In addition, they're going to fund a margin on the value of benefits accruing. So each year a contribution is made that funds the benefits plus a margin. Then what happens once benefits are earned, and this happens both while someone is working and through retirement, when the market goes up above the hurdle rate, benefits go up, and if the market returns something lower than the hurdle rate, benefits go down. So as an example, if we had a 4% hurdle rate plan and we got a 6% return, benefits would go up 2%. Likewise, if we got a 0% return, benefits would go down 4%, the difference between the hurdle rate and the actual return. The result is that the plan stays fully funded in all market conditions. The market return, the investment return, essentially gets borne through the benefits of the plan, and the interest rate sensitivity is eliminated by calculating everything at the hurdle rate. These plans are very, very stable. What we do then is, now what I've just described is the basic variable plan, and what happens in that is that benefits go up and down, both while people are active and through retirement, which has been not very palatable to a lot of plan sponsors. So what we did to create the sustainable income plan is we said, in years of particular outperformance in the market, we're going to hold back a portion of that return, and instead of having it increase benefits, we're going to hold it in reserve, in addition to the margin on the contribution, and those two sources of income will be used to shore benefits up when they would otherwise go down, so that retirees see flat benefits in down markets and rising benefits in up markets. And here is a picture of the benefit pattern for a typical participant, career participant. So here's somebody who starts at age 35, retires at 65. The blue line is the fully funded benefit. The green line is what we pay to retirees, and the difference between those is funded out of the reserve. In the event that the reserves run out, we don't jeopardize the funding of the plan. The benefits actually decline to a lower rate. So you can see what we're doing here is providing some inflation protection to participants at the same time that we're providing stable contributions to the sponsor. So this benefit pays a lifelong benefit like a defined benefit. The employer gets the advantage of a level percent of pay contribution like DC, and then the employer has balance sheet stability, and you avoid variable rate PBGC premiums. Now, that is true if you start a sustainable income plan from scratch. So our DC sponsor right now that's looking to do this will have this from the outset. But in terms of an immediate impact, it doesn't happen that quickly. In the immediate, you still have to fund your traditional plan liabilities if you're a pension plan sponsor, and you still need to maintain that portion of the plan and make contributions to that portion of the plan. Plans that are doing this really set up two sub-accounts, and they track the assets and liabilities of the two pieces of the plan separately to ensure good funding over time. In terms of auditing and accounting, there's no accounting impact. All you did was change your benefit structure going forward. But you do want to talk to your auditor. There are a couple of different ways you can actually present the auditing numbers, and so it's important to work with your auditor because these plans aren't particularly common. The variation that allowed for the sustainable income plan allows for other variations as well on that old variable design, and some regulations were published in 2014. The hybrid plan regulations were published in 2014 that really opens up the possibility to more types of these variable benefit plans.
Kelly, do you have to be a certain size to use this supplement, the sustainable income plan?
No, I mean, I would say if you're big enough to sponsor a defined benefit plan, the cost structure is very, very similar for a variable plan. So there's still the barrier to entry. If you have 50 participants, it's pretty costly to put in a defined benefit plan, so you have those same barriers. When we talk to people who are putting them in new, I recommend people do that who have at least 1,000 participants or 500 participants who are quite well paid, something so that the administration cost doesn't feel large on a per participant basis.
Okay, great, thank you. And we have a couple questions we're going to go, I know we're a little over, but I think we can cover them. So one is on PBGC fees. It's like, do we have any thing on the expenses? Is it like a percentage of assets or benefits?
Yeah, so for a single employer plan, PBGC fees are a combination of two things. One is a flat rate per head cost of $74 per person per year. And the second is a fee of a variable rate portion, which is 3.8% of the underfunding on a PBGC basis. And that is capped at about $500 per participant. So one of the advantages that we find of a sustainable income plan is that because of its design, it stays fully funded, so there'll be no variable rate premium for, say, a new sustainable income plan. So then it'd be limited to the per participant cost of about $74 per participant.
Got it. And one last question, this is a good one because we've gotten this quite a bit from sponsors, is the mobility of benefits, right? So the defined benefit plans is, can an employee move, what if they move around a lot? Is that harder for them to actually estimate their, retirement funds as opposed to if you had a DC plan, right, that you can just take with you a known amount? Do you have any thoughts on that, you two?
Well, I think that you're right. If you work at several different employers with defined benefit plans, it gets difficult to sort of keep track of those things and figure out what the right date to retire is. I really think it's optimistic, though, to assume that what people do is transfer their 401k balances with them when they go places. We see a lot of people who take at least a portion of that as cash when they leave one place and move to another. So it is true that the defined benefit plans and the alternatives are not as sustainable, are not as portable, but we think on trade-off that might be better than people turning their 401k assets into boats.
Yeah, true. Well, thank you, everyone. Thank you for staying with us a little longer, and we're going to turn it over to Emily.
All right. Thank you, Bertha, and thank you, Kelly and Arthur, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.